Hi there, and welcome back to this CashCalc training series. We've covered off a huge amount throughout these first 4 videos. This fifth one is going to start where we left off. We're going to cover off the rest of these calculators. We're pretty much halfway through it already. So we're going to start off with these VCT and EIS calculators. As you can imagine, they're very, very similar, given the investments themselves are fairly similar. But if I click on VCT, we'll start with the VCT calculator first. Quite simple. You start off on the left-hand side. You've got to judge what growth rate you want to assume over the coming years. Now, I've used analytics in the background, our very popular fund research tool, and we've got a lot of VCT data on analytics, and it's showed me that over the last 5, 10, 20, 25 years, the average return of a VCT was working out roughly about 4 or 5%. So I'm going to use that logic and put an assumed growth rate of 5, going to push that out up over 25 years, save and calculate that first bit. Then over here, I'm going to suggest the client invest £10,000. We'll start off with a really simple example. Invest £10,000 into a VCT and calculate. And at the very bottom here, I've got a 25-year chart. The asset itself, £10,000, growing at 4%. That's obviously that green line. The blue line, if I hover over any year, it will give me the actual the mass. The blue line is the cost of the client, so it cost the client 10,000, so that's always going to be static. The tax relief, they get that 30% tax relief today, so that's £3,000 tax relief. So the real cost of the client is that yellow line is 7,000, and then the tax relief is 3, which is that red line, all static because nothing's changed. But I can now start adding a bit of complexity into this. So I can suggest, again, as per the VCT rules, to reinvest every 5 years. So just basically recycle that £10,000 and claim tax relief every 5 years. So if I calculate, suddenly the chart looks a bit more interesting. And that red line, that tax relief, is incrementally going up every 5 years as I claim the 30% up until 2038, where the tax relief claimed is actually more than what the client put in. They put in 10,000 all those years ago, but then by the time 2038 rolls around, they've claimed £12,000 in tax relief. So they've actually gained 2,000 more than what they put in. And obviously the kind of the yellow line is the real cost to the client, which is obviously going the opposite way. It's kind of coming down as that tax relief increases. But then again, you could add more complexity. I could say, okay, maybe my suggestion to the client is to put £10,000 in every year for the first 5 years, so 50,000 in total, and then recycle over the coming 25 years. So again, you can see with my chart, suddenly that kind of blue line races up to 50,000 put in, and then it remains, it kind of flat lines, and then you can see that tax relief going up, the cost of the client clearly going down, up until, if I hover over the very last year, you can see the cost of the client was always 50 because that's how much they put in. The tax relief they've claimed is 75,000, so they've actually the real cost to them is minus 25,000, and the growth of that asset, if it has grown at 4% a year, would now be worth 146,000. So a really nice way of illustrating to clients how VCT investments work. And again, if you click on Create Report, you get the cover page with your logo, and then all of the information that we input, the assumptions, and that nice little chart underneath, and the year-on-year analysis thereafter. So that's the VCT calculator. So the EIS calculator is almost identical to the VCT calculator, bar just a couple of tax complexities. So start off on the left-hand side. How much is the client looking to invest in this EIS scheme? What's the growth rate over the coming years? What's the time frame you want to project over? Industry standard to disinvest or kind of recycle that asset is generally 4 years, although clearly the minimum term you need to hold in the EIS scheme is 3 years. You can kind of flex that between 3 and 5 years, but the default will be 4. And again, do you want to keep those funds invested? So you can look at very similar charts to what we started off on the VCT calculator, just showing the cost of the client, the tax relief, and the kind of the real cost of the client and the growth. Or do you want to look at reinvesting that asset 3, 4, every 5 years, etc., whatever you've selected at the top. And again, it gives me almost an identical chart to what we had before, looking at the 30% tax relief you get, in this case, every 4 years. Now, again, the added kind of complexity with an EIS is you can defer that capital gains tax. So on the left-hand side, I can also say that the gain my client is using the EIS scheme for to defer, they've made a £10,000 capital gain elsewhere, they're going to use that in this EIS scheme to defer that potential tax charge. What is the tax rate going to be once they sell? It's going to be 20%, maybe lower than what they're currently paying at the moment. So therefore, the charge at the end of this is going to be that £2,000. We're using that EIS scheme to defer it, but also because it qualifies for PBR after the 2 years, it also shows you, in terms from an IHT planning perspective, it shows you how much money the client could save if they held this asset and then died within the next 2 years or after the next 2 years. And then the report, as you can imagine, looks very, very similar to one we just looked at with the VCT calculator. You've got the cover page, you've got the intro, you've also got the assumptions, you've got that nice chart that then generates off the back of those assumptions, the year-on-year analysis, but also because it's an EIS, it shows you the capital gain they're looking to defer, which is the 10,000, the tax charge at 20% rate, and then also again that PBR qualifying amount that could also be saved. So that's the EIS calculator. So our average annualized performance calculator does exactly that. It basically works out the annualized performance of a particular investment scenario. So on the left-hand side, you pop in how much the client invested initially, start date and end dates. This is over a 10-year window. How much they've taken out, so 2,000, and how much that policy is worth now, 67,000. If I click on Save and Calculate, it gives me some basic bits of information at the top here. It tells me my total return is 29,000. So the client's made 29,000, which is basically what the policy is worth now, plus the 2,000 is 69. And then take away 40 gives you the 29 gain. On a percentage basis, that's 72.5%. So basically 72.5% of 40,000 is 29,000. So that's their gain. And over a 10-year window, a basic annualized figure would be 7.25. Basically, it's kind of average 7.25 a year, every year for 10 years. 7.25 times 10 equals, of course, that. But that's not true in investment world because of compounding. So actually, the compounded rate is 5.6 because an investment growing at 7.25 every year for 10 years is going to be more than 72.5% because of the compounding nature of investment. So actually the real annualized compound return is 5.6. Your investment every year, if it grows at 5.6%, would be 72.5%. So it's giving you the real average compounded return of that particular scenario. Our rental yield calculator is a really nice way for advisors to illustrate to their client the level of yield or income they'll receive off a particular asset, given the expenditure as well they're likely to spend on it over the years. So the example I've got over on the left-hand side under assumptions, I've named this my second home. So this is an example of a property rental yield. So client's second home, I'm assuming that asset's going to grow at 4% a year, and I'm also assuming there's going to be a 2.5% inflation over the coming years. So in real returns, 1.5%. Property's worth $500,000 today. The amount of money in the cash account right now to pay for expenses is 20,000. And what about the rental income? I can either express that as a percentage or pound amount. So if I think the client's going to make £20,000 a year in rental income, I can just put 20,000 in there, or I'm going to do this in percentages and say I expect them to make at least 4% a year rental income, which at the moment is £20,000. Save and calculate, run this over 20 years or however many years you like. And then I can start adding in some expenses as well. As you can see, the client might need to fit a new bathroom at some stage, or add the yearly maintenance cost, new kitchen, stamp duty, legal cost, etc. And when you want to add an expense, you click on the blue button, explain what that expense is, how much it's worth, whether it's a yearly or one-off cost. If it's either or, you can adjust for inflation. But if it's a yearly cost, I need to specify the start and the end date. Maybe I want to run that throughout the entire length of the forecast, or maybe a one-off cost like a new bathroom or a new kitchen, etc. Or the stamp duty. I can then specify the date I want to have the client spend on that. Click on add that in, and then you get the nice graphic underneath after you've saved this underneath the overall rental kind of running total yield for the second home over that entire forecast. But then you get the year-on-year breakdown showing, look, the house is worth $500,000 today, growing at 1.5. What's that's going to be worth after 20 years, and plus that 20,000 sitting in my cash account at the moment. If it's growing at 4%, I'm using my asset to grow it at 4%. What's that cash doing each year? And then the maths underneath. So this year the house is worth $500,000. If that grows at 1.5% real term, then it's going to be 507,500 at the end of it. We've got 20,000 sitting in that cash account at the moment. We're going to add another 20,000 this year because 4% of 500,000 is 20,000. Add those two together and take away the expenditure, gives you 34,000 in your cash account at the end of the year. And in terms of the actual yield, 4% a year is the rental income we expect to get every year for that asset. Then we've got add the 1.5 for the property itself going up in value. That's 5.5 in total, but then you remove all the expenditure and you get a running total net yield of 4.3 a year, 4.32, 4.34, etc., all the way down to the bottom, 4.6. And again, when you want to put that into a report, create a report at the top, Word report, PDF, either or, gives you a nice 5-page with your cover page, logo, introduction in terms of what the rental yield calculator is, some assumptions, that nice chart, and then finally that running total year-on-year analysis over the next 20 years. So that is the rental yield calculator. The chargeable gains calculator quickly works out the tax liability on a chargeable gain within an investment bond. So you start off on the left-hand side at the top under income. In this case, it's husband and wife. I'll ignore the wife's details for this particular case. We'll just assume it's husband. So husband, 48,000 in non-bond related income for this year. What's the personal allowance still available? What's the bond information? So I've already added a bond in here, but you can add as many as you like just by hitting this button. I will edit this one just to show you what the inputs look like. So you've got the bond name itself. In this case, it's a Aviva insurance bond. That's the amount that went in originally. There's the current value, so that the gain, if fully in cash today, would be of that 50,000. They've held it for a full 8 years. Is it onshore or offshore? Obviously, that would change the tax calculations in the background. Is this a full encashment, or are we just partially encashing some of it? And how many policies does this relate to? And then again, I can say whether this bond is held by husband, wife, or joint. Once you've added in the bond information, you can then say what withdrawals have happened in the background. The system very quickly works out what that 5% allowance is, given the inputs you've just made a second ago. So it works out that on an absolute basis, you can take 5,000 every year, and then it works out the cumulative effect of that as well. Now, if it's the case that the client has indeed taken their full allowance every year, rather than having to type in 5,000 every single year 8 times, you can just simply pop in 5,000 at the top and then populate. It populates all of them. And for whatever reason, if they've taken too much in one year, it would actually tell you that is a chargeable event and what the excess is, how much that's gone over, and that will obviously be worked out in the background in the tax when we get onto the results. In this case, there has been no withdrawals, so I'll just populate that. 0 top-ups, exactly the same in reverse, how much has gone in. And then in terms of the results, it will then work out, based on all of those inputs, what the overall tax liability is this year, based on the tax on the chargeable event, the gain, the 50,000, and the tax due on the income, the non-bond related income. And if you expand it out, it gives you further details. So it tells you, look, that the current value is 150, given it was 100,000 invested initially, the gain is 50. Divide that by the full 8 years, you've got a top slice of 6250. And then it shows you the tax liability of each of those parts. So the initial taxable income, the 48,000 of income that client's made, non-bond related income, that's the tax due on that. Then the tax on the gain, the 50,000, that would be the tax based on that. Then the top slice, what that looks like. And then it shows you that in terms of the liability, 7 plus 19 equals 26,000 in total, minus the tax relief, means that 26 minus the 13 relief gives you 12,654, and divide that up between the tax on the actual chargeable event, the gain, and the tax on the income is 5 and 7, hence the figures at the very top here. And if you want to then create a report, click on the little blue button at the top, PDF or Word, and it just gives you, again, same as all of the other calculators. It gives you the cover page, it gives you the intro of what this is, then it gives you the assumptions you've made, the inputs, withdrawals, etc., and then the tax calculations at the very bottom of that. So that's our chargeable gain calculator. So our reduction in yield tool also doubles up as a pension switch calculator, and it allows you to quickly compare the associated costs of one solution versus another and the drag on the performance of those costs. You don't have to do 2 portfolios. So this is, oh, you can name them whatever you like, but I've called them portfolio A is proposed, portfolio B is existing solution. If I don't want to compare 2 and just want to focus on one, you can, of course, just deselect the second. What's the investment amount going in? So this is a 400k transfer. Are there any contributions and withdrawals being made over the coming years? You can pop those figures in monthly or yearly for both. What's the investment period you want to project over? In this case, I want to do 20 years, or you can actually set an age of the client as well, given it knows the client's date of birth. On the left-hand side, you can then specify the growth rate you want to use for this projection. So I'm just going to assume 4%, but if those of you that want to do maybe a 2, 4, and 6, or 3 different growth rates, you can just keep adding more growth rates and it will work them all out for you. But I'm just going to make this simple and just do one growth rate, 4%, 4%, the same on both. The important one, charges. What are the charges of portfolio A, proposed versus existing? You just work your way down. So for me, I've put 0.5% charge for my advisor fee, 0.5% charge for the portfolio charge. For the platform fee, it can be a flat fee. And by the way, you can put pound amounts rather than percentages if you like. But for the platform fee, you can add tiered options. So if you click on advanced options, you can build your own tiers just by clicking add threshold and building these in. So for my the platform that I'm using, from £0 invested to 200,000, there's a flat fee of 0.45. But then from 200,000 to 250, it's 0.35, etc., and over 500,000, it's not charged at all. So they'll be added at the very bottom down here, those tiered charges, and that will work that out again in the background based on the amount of money you're putting in. Then other charges, I've put DFM fee, 0.15. I'm using a DFM MPS. You can add other charges just by clicking that button and adding as many as you like. And then for the existing solution, again, I've put the advisor fee 0.5%, the annual portfolio charge 0.8, and the platform fee is a flat 0.4, no other charges. Now, particularly for existing solutions, if you don't have the charging information or you're finding it really tricky to find, you probably will have the projected values from the existing schemes. So if they've already sent that across to you, feel free to use that instead. You can just tick that button and type in the projected value they've given you, and then the system will work it back from there. But I do have the charges, so I won't bother using that. I'll use this instead. And once you've popped in all the information, you can click on results, give that a second or two. That will work that out. And it will say, look, based on a 4% growth rate, my proposed solution after 20 years will be worth 654 off that 400k investment. Your one, Mr. or Mrs. Client, will be 626. So it's 28 grand less because of that higher charge. The yield is not 4% on mine. It's basically 2.49 if you take away the charges. So the charges are having an effect of reducing my yield by 1.51. Yours is 173, which is 0.22 higher, which basically means your portfolio is going to have to grow at 4.22 to keep pace with mine if we both grow at 4%, or if we're targeting to grow at 4%. And then underneath, a nice little graphic that shows that drag on the performance. So as you can see, each year my proposed solution just slowly creeps further ahead than the existing one until that big delta at the very top that's illustrated at the very top of my page. And then the year-on-year analysis underneath, showing again how it slowly creeps away and gets to be a higher value at the end for my proposed. You can toggle between the two as well, so that's looking at the two, but I can zone in and look at the proposed solution on its own, and also the existing solution on its own as well. And once you're happy with that, you can click on Create Report. You can PDF or Word, and the final report will give you that cover page with the logo. It will give the introduction as well in terms of what the reduction yield is, and then it will give you the assumptions that we've made, the amount of money going in, the charges, the tiered charges as well illustrated, and then those final graphics, the proposed versus existing figures, then just the proposed running at 4%, and just the existing running at 4% as well. So that's our ROI calculator. Our state pension age calculator barely needs explaining, incredibly simple. You've just got to simply type in the date of birth of your clients, his and her, Mr. and Mrs., whether they're male or female, click on calculate, and it will then just simply work out the date at which they'll reach state pension age. In this case, 1st of January 2031 and 1st of June 2031. So our income protection and PHR, permanent health insurance calculator, helps an advisor very quickly compare the current income protection someone has in place versus what they're proposing or what they need. So starts on the left-hand side, where you've got to tell the system what the gross salary is of this client, and then you've got to input what the current cover is. So does the client have an employer sick pay policy in place? He does. In this case, it's statutory and it covers for 28 weeks. If there is additional sick pay available, you can just pop that in, whether it's full, half, etc., and how much that's worth. He does have an existing income protection policy in place. It's with L&G. That covers him for £500 a week, delayed or deferred for 12 weeks initially, and then all the way up until his retirement age, and that is index linked. So that's what he's got in place at the moment. He's also got some protection for ill health from his pension. So Phoenix, his pension provider, will provide £250 a week cover commencing after 52 weeks. And then also that cover is payable for life or up until retirement. The cover is index linked. And what does he need? Well, we've deemed that he needs 60% of his gross salary, or that's what the client wants. Delayed or deferred, happy for that to be delayed for 12 weeks, and then again up until retirement age and index linked. If you don't want the maximum cover, you can just simply deselect that and then pop your own weekly amount in, and it does actually work out what that maximum is for you. But I'm just going to say it needs 60% covered. And if you click on Save Calculator, it gives you a nice little graphic on the right-hand side that will compare current protection versus proposed protection. So the current cover is that employer sick pay covering 28 weeks at £90 a week, covers £2,500 in total. Then you've got the pension that pays £250 a week, and that covers 364 weeks, and that small income protection policy in place that will cover another £500 a week for the full 404 weeks up until retirement. So that's what he has in total. What we're proposing over here is, again, with the sick pay from work, with the pension, we just need to increase that income protection in place he's got over here. So instead of 500, he needs £903 a week for the full 404 weeks up until retirement, and that will cover 429,000. So in total, it will give him an extra 191,000 over that full term. And the weekly difference, therefore, he needs to increase the protection by £403 and nearly £404 every week, and it will give him the same amount of weeks cover all the way up until retirement. So if you want to PDF that, create a report at the very top, PDF or Word again, and it will give you a nice little summary again, cover page with the logo, introduction in terms of what this calculator is, and then what's currently in place with those existing plans, what the potential plan is that we're now proposing, and then the side-by-side analysis. There's the current cover versus the potential cover that we're now recommending, and underneath that, the difference between the two. So that's the income protection PHI calculator. So the stamp duty calculator is another super simple calculator that only takes probably a minute to explain. On the left-hand side, you pop in how much the house is worth that's being purchased, whether it's first-time purchase, additional residential property purchase, and Scottish or wealth tax rates, etc. And if you click on Save, it will then work out on the right-hand side. It will bring through the correct tax rates, and then it will apply those bandings, and then it will tell you on the right-hand side how much tax is due. On the left-hand side, you can also say if it is a first-time purchase, obviously the tax rates change, and then suddenly the taxable amount is a lot less. Equally, could be an additional residential property purchase. So again, different tax rates apply, and then it's 27,500, and again the same with Scottish and Welsh tax rates. And again, if you want to report, just click on that blue button at the top right. Another really simple calculator here, TR-OCF. It will very quickly work out the overall TR/OCF of a solution you're putting together for a client. So the example I've got here is my portfolio has 4 funds in it. I've just called them Fund A, B, C, D. There's the percentage weightings I hold in each. Adds up to 100, of course, and then the TR/OCF of each one of those funds. Now, to add a fund, you just need to hit the blue button, gives you a new row. Then you can type in the information of the fund name, the percentage, the TR, and then it will add that together for you. If I just delete that for the purpose of this demonstration, and the moment you click on Save Calculate, it works out and aggregates those charges and says that the total OCF of that portfolio is 0.891. You can then add advisor fee and platform fee as well. So maybe my advisor fee is 0.5%, and my platform fee is maybe 0.3. And if you click on Save and Calculate, that adds that together and says, again, the total OCF of that solution, advisor fee, platform fee, fund charges or portfolio charges is 1.691%. So the average growth calculator, it's another very simple tool. It will basically work out the average growth rate of a basket of funds. So in this case, I've just, again, input fund A, B, C, D. You can have as few or as many as you like. You just keep on add fund and adding the necessary details. The amount invested into each one, it will automatically works out the percentage holding for you. The growth rate, you're either assuming or looking back historically, either way you want to go. And if you click on Save and Calculate, it works out based on the growth rates of the individual funds and the percentage weightings in each. The simple average growth on the whole portfolio is 7.272 a year. And the school fees calculator is a bit of a goal-based planning tool. It allows your clients to understand how much they're going to need to save every month to pay for school fees or university tuition fees, etc. So on the left-hand side, the assumptions are here. So you can pop in the child's name. Current savings the parents have is 0, so we'll just leave that at that. University type, is it school fees planning or is it university tuition fees we're looking to cover? Ultimately, if you change, it doesn't change any of the calculations. It just simply changes the wording on the report to make it look slightly more relevant. But this is a university case. I'm going to assume the pot grows at 4%, all these savings that have been put away. I'm going to assume inflation's at 2.5, so the real rate of return is going to be 1.5 in total. Child is currently 12 years old, aiming to go to university in 6 years, and they're going to be there for 3 years. So they're going to end when they're 21. And if you save that, then there's 3 different goals you can start looking at. So maybe the parents are happy to, maybe they've got a surplus income and they can maybe save £500 a month. So they want to know how much that would cover. So we can put £500 a month, and we can show the client that if you put in £500 a month, by the time your child reaches the age of 18 and wants to go to university, there's a nice pot size of 37, and that will cover tuition fees and university fees of 12,500. And underneath that, it will give the month by month breakdown. That £500 being added to this pot grows all the way until that client hits, the child hits 18. Then we start drawing down that pot, 1,047 every single month up until the pot's exhausted when they leave university at 21. And you can do annual as well, so you don't just have to do monthly. Alternatively, you might want to show, or the client might want to see how much it would take to reach a target size. So actually, we know that university is going to cost £10,000 a year, so it's going to be £30,000 pot I need. So what does that look like? Well, we can say, well, in that case, you only need to invest £398 a month, and assuming it grows at 4% a year, that will get you that 30,000 pot by the time that child's hit 18, and that will cover the £10,000 a year you need to cover until the child leaves university or school at a particular age. And then finally, we might know the yearly rate as opposed to, we might want to show the yearly rate instead of the pot size. So maybe my client knows that the costs associated with the university mean that they're going to need to save to cover £15,000 a year. So again, what does that look like? Well, I can tell you, Mr. and Mrs. Client, you'll need to save 597 every month. That will give you a pot size of 45,000 by the time the child hits 18, and that will cover that £15,000 a year every year. So 3 slightly different goals, but all kind of showing the same thing and helping clients understand how much they need to cover their child's school or university fees.